Welcome to Radio Davos, the podcast from the World Economic Forum that looks at the biggest challenges and how we might solve them. This week, as the World Economic Forum starts its annual meeting in Davos, Switzerland, it has just launched the latest edition of the Chief Economists Outlook. That's the survey of chief economists around the world that the forum publishes every 4 months. It reflects both the state of the economy right now and what to look out for in the future. I'm John Letzing, economics editor at the Forum, and helping me assess the state of the global economy is Christian Keller, head of economics research at Barclays Investment Bank. Welcome, Christian.
Hi, John. Happy to be here.
So the latest outlook describes the prevailing mood as one of vigilant anticipation. I'm wondering if you think that's an accurate description of the mood, and sort of what your big picture takeaway is from this edition of the Outlook.
Yeah, plus, I would say the Outlook, it's a briefing. I think it's useful. It's a pretty diverse group of chief economists, not only financial sector, but really from across the private sector, from mining to tech to retail. And I think that's a useful overview of opinion that the World Economic Forum puts together. And, while if you go back, it's rarely that you make the right forecast, but it's a good instrument to have to go into the year. I think Eisenhower once said, plans are nothing, planning is everything. And so I think this is how I view this outlook and this survey. As you say, it's coming out every 4 months. And even if you believe the predictions are not necessarily right, it gives you a nice kind of a time-consistent view how things and how views of economists who look at this develop over time. Now, you said about the current outlook. I think it is really reflecting a tension that economists have, and that is between seeing a lot of fundamental developments. When you look at fragmentation of global trade, investment patterns, intensifying geopolitical tensions, you look at those and you would think that's pretty negative. But then you see at the same time financial markets have reacted quite well, and they've been continuing to rally, if you want. And so, how do you put those two together? Are they consistent? Does something need to adjust? I think AI plays a big role. That was discussed in the survey as well. I think the one positive development that maybe overshadowed a lot of the negative developments that I just mentioned was this big AI investment boom. And now I think you feel the tension in this survey between economists on the one hand, seeing these developments that, shouldn't be good for a global economy. As I said, the trade tension, the fragmentation of the global economy. And on the other hand, you see the big promise of AI, the already happening investment boom, and the promise of future productivity growth. And I think this tension and whether there could be a potential adjustment, for example, in tech valuations, I think that has really been a characteristic of this report.
I think, for anyone who has paid any attention to any economic or financial or really any news in the past year or so, they probably heard a lot about tariffs and protectionism, and they may have heard from economists about all of the negative impact they may have. And yet, as you point out, the global economy has proven seemingly pretty resilient. So were economists potentially at least a little bit wrong about tariffs, or how do we explain the resilience?
Yeah, I think you put your finger into something that economists have been already debating all last year. If you look at not only, us as a group, but also the IMF, the World Bank, almost all international organizations, all economists had to several times revise up their forecasts from earlier forecasts, in particular from forecasts that were made after the events in April. And, not retelling the entire story, but I do think it's important. The announcement on so-called Liberation Day about massive tariffs, really had a big impact on markets. And economists looked at this and said, oh, wow, this is going to be horrible from a perspective of what the tariffs will do, but also from the massive uncertainty it will create. Now, what happened since then was, the tariffs weren't implemented to the extent that they were announced. So markets quickly realized that and calmed down. Second, There was a big delay in the implementation. There are a lot of exemptions. We can go through them. There's been front running. There's also a lot of transshipment. So ultimately, the tariffs were less in a way than initially feared. Maybe economists also underestimated a bit the agility of the private sector in preparing and being able to deal with these kind of not fully unexpected, but these kind of shocks. So I think economists cannot completely disown this. They were wrong, but I think there's a point to be made that a lot of this was delayed, and also, by the way, a lot of this may still come. For example, a lot of the price increases for U.S. core goods may still happening in 2026. So I think the same way economists were probably wrong expecting things to immediately deteriorate, it may now be wrong to be overly optimistic that there'll be no impact from this going forward, when maybe many of these things are still in the pipeline to have negative impacts in 2026 and beyond.
And you mentioned front loading, right? And maybe we should explain a little bit what that means. That is, if I understand right, that essentially companies in anticipation of tariffs imported or exported or essentially got goods to where they wanted to get them before the tariffs came into effect. Is that right?
Very much so. Even though Liberation Day came as a surprise in the sense of the level or the rates that were announced were very much higher than people maybe anticipated. But it was very clear from the election of Trump already, in November 2024, that there would be tariffs. And so companies were quite good in filling their warehouses and doing exactly what you said, front running the tariffs in the sense of, getting the stuff into the warehouse, into the inventories before the tariffs came. And now, that meant that they could then, would not have to import after when the high tariffs came. This, of course, cannot last forever, right? At some point, the warehouse is depleted. You got to import, the stuff at a higher tariff, and you will have to pass through to consumers. If not, you have such a high margin that you say, "Oh, I reduce my margin." But a lot of the companies are not able to do this, and we know, also from what companies say, that as they have the higher inventory costs, they would have to pass them through. There's also a lot of transshipment going on. So what you see now is that goods can no longer go from China directly in the US. They go through Vietnam, through Mexico at lower tariffs. And so ultimately, goods no longer as direct Chinese goods imports, but through other countries are coming into the US. It's a question how strongly the US really wants to, in a way, close that down, or whether actually there's an implicit understanding that is a way how one can still, keep cheap goods coming in from China through this kind of rerouting.
And then in terms of AI and AI adoption, that's a big part of the outlook, of course. One thing that jumped out at me was the chief economist's responses about projected impact on employment and job losses related to AI. Now, they seem to believe that even 10 years from now, we'll be seeing some job losses related to AI. And that seems a bit daunting. Is it as daunting as it seems, though?
May I take one step back? I think we talked a lot about the tariffs, about the economic impact. I think what economists did not see last year, and then I come to your question on unemployment and the outlook for AI. What economists did not see, even though AI already existed, right? The large language models already were a few years old. The massive investment boom in AI and what that created, that offset a lot of the negative effects from tariffs. You saw large investments. You saw these also massive valuation improvements on stock markets, which create a wealth effect, which is important not for all Americans, but for many Americans. So you had Americans boosted their wealth through these elevated stock valuations. They were willing to spend. That supported consumption. So AI had an impact directly through increased investment in AI-related assets, energy, data centers, etc., but at the same time through the wealth effect. Just to say that was a very, very important effect in 2025, while things did probably better than they had done if we had just the trade war, if you want, without without the AI. Now, on the outlook for AI and on jobs, there is always this tension between, how much will a new technology substitute or complement? And to the extent that it substitutes, it automates, jobs are lost. And to the extent that it complements, people become more productive, can, earn higher wages. And that has been in history through, all the technology advances that we have seen, always been a positive. Jobs will certainly be lost in certain areas. The question is, what new jobs will be created that we may not even think of today? So whether the net effect will be, that we have less work, I know that this is something that comes out in the survey, but as long as you don't have maybe what people call, singularity, the artificial general AI, where machines do everything, it would seem that the past has told us, there'll be new jobs and that we cannot even think of. And typically, these massive unemployment scenarios never play out. I would say one thing, though, is it's not so much about having a job and whether there's some work for humans to do. It's also a question of how they will be remunerated. And so a person for whom AI is an accelerator, a complement, and the person who can do more productive, be more productive in their job, they may earn more, including the people, obviously, who own the capital, who sell AI or own AI. But there may be people who, still find jobs, but if they're automated under the fear of substitution of automation, that will have an impact on their job. So it may be not an issue so much of job losses, but of rising inequality in pay.
And we discussed, of course, some of the positive effects of this AI investment boom. There has, of course, also been talk about whether or not that constitutes a bubble. And there seems to be some sentiment in this outlook, some anticipation of a reckoning of some sort, whether it's a bubble burst or a drawdown, however you want to describe it. Do you see an event like that on the horizon, I guess? And why should someone, even someone who maybe not even directly or indirectly owns AI-related stocks in the U.S., why should somebody like that, I guess, be concerned about something like that?
It's the question, I think, at the moment, because as I said earlier, a lot of the outperformance of the U.S. economy, despite all these policy disruptions, was really on the basis of AI, as I discussed earlier. So, whether this is sustainable or whether this is now in the area of bubble of euphoria is really a key question. And it's a macroeconomic question. It's no longer an issue of, oh, do I own that particular stock and may I lose money after making a lot in the last few years? It's a matter of macro stability or macro performance in terms of growth. And it will affect probably everyone. I mean, first of all, I would say, even those who believe they don't own tech stocks, they may not in a portfolio where they directly own them, but if they have some kind of investment or they have a pension invested in stocks, they're probably more exposed than they may think, even if they're not in the US, because US stocks have such a large share in the global value of stocks. And the Magnificent Seven, or the highly concentrated tech stocks, play such a large role that probably everyone will be affected, even though those who obviously own them in large shares, would be impacted most. The reason why people have been more relaxed about this at this point is that in contrast, for example, to the dot-com bubble that often cited from the late 90s, so far at least, the boom in investment has not been driven by debt. These are companies, large companies, well-established business models with very good earnings and very high cash cushions. They use that cushion and their earnings to invest in something they believe in, which is already driving earnings, but they believe can boost earnings massively in the future due to increased productivity, etc. So that is the theme, and that, I think, creates a lot more confidence by a lot of investors. Now, more recently, as many have pointed out, the debt part of it is increasing. For example, investments in energy, in the necessary data center, energy nets, etc. That is now a lot of times done by debt. We have record debt issuance already in the first few weeks of this year. So, the more debt is involved, the bigger leverage is. And that, of course, depending how long it goes, then creates more risk. And the biggest risk we saw in the GFC, when there was a lot of widespread leverage, but among households as well, and of course invested in real estate. Real estate plays a very particular role in collateral for banking, for banks, etc. This time, the leverage is more concentrated. It's not with households. The banking system is not that involved. This is not, as I said, it's not driven by the real estate sector. It's not an unproductive investment. It's not houses. It's supposedly investment in something that should catapult us into a high productivity era. And those are the reasons why people say, look, even if it is a bubble, it's probably a good bubble. If some valuation is correct, we may end up still with having good infrastructure, tech infrastructure, which would help us. People use the example of the fiber optic cables of the 90s that were laid. Telecom companies who did it didn't do well, but they created an infrastructure that then really provided the basis for the development of a digital economy.
And when you say GFC, of course, you're referring to, I guess, the
global financial crisis in 2008,
yes.
9, yeah.
Maybe we could turn a little bit to cost of living. Cost of living is a very serious issue in some places more than others, can have very, very significant impact and far-reaching results. Looking ahead to the year, where do you see inflation biting maybe the most, and why is that a concern?
Let me make one point up front. And, we economists are very used to talk about inflation, which is a rate. And then we talk an acceleration and a deceleration of that rate of increase year on year. But I think why it touches so many people is, they look at price levels. You go to Manhattan and you buy a coffee and you remember at what price you bought it for 5 or, let's say 6 years ago. It just shocks you, even though the price may not have increased from last year. So the inflation of that coffee from last year to now may not have been that high. But because inflation was so high a few years ago, we're now dealing with levels that, people on the street or consumers are confronted with every day. And if their wages didn't go up by the same amount, even if you tell them inflation is now much lower, but they see the level of the price. I think this is very important for the debate. I think that's why it's so politically important. It played a huge role in New York, mayoral race, and it will play a big role in the upcoming midterm elections. And it's at the moment very much focused on the U.S. because in Europe, affordability is an issue, but at least inflation rate is back at 2% and sits there quite stable. U.S. it's still higher, and I think there's a bit more of a tension between a government wanting growth to continue to be high and support that through policy, while if you look at inflation itself, it would indicate to you that you actually should probably run a bit of a tighter macroeconomic policies, and that tension, could lead now, maybe some governments opting for more direct intervention into prices, etc. Which sometimes by the population is seen as an immediate remedy, but history and we economists, in a way, don't believe in it because history has shown that typically doesn't work. But I think it will be a key topic for 2026.
Indeed. One of the more interesting things in this outlook that jumped out at me was a sentiment among chief economists that when it comes to public debt, it may be that many governments will be content to just let inflation reduce those public debt levels rather than any sort of active efforts on their part. Maybe could you help us understand a little bit how that might work and whether or not we think that's a good idea?
Well, it's if you have a high debts, there's only a limited amount of how to deal with them. You can outgrow it. You can, and that has happened in episodes. You can default. That's obviously everyone wants to avoid. Or you can do a mixture of what you just described. You, in a way, try to inflate it away. Now, typically, markets, if they're free to buy your debt, if they realize inflation is high, they will demand a higher interest rate. And depending, on your profile of debt, how short the maturities are, whether it is linked to inflation, it is not that easy. Investors are not stupid when buying debt. So you have to do what we call financial repression. So you force them through some rules also to buy debt, and then you inflate it away so they hold debt at negative real rates, which is key, right? I think and governments always may try to do this. I think at the moment there's also the feeling of, let's keep nominal growth high, which is, on one hand, inflation, but also, do policies that continue to boost growth, or at least help either keep growth high in the case of the US or bring growth up in the case of Europe, for example. And if you have high nominal growth, as long as that high, or at least the same level as your nominal interest rate, you can keep that stable. I think this is what governments try. I think ultimately, maybe not in all economies, but in many, there will be a time of reckoning. It always comes a bit later than maybe economists thought, but at some point, I think there will be probably more painful fiscal measures that will be necessary.
One other aspect of the outlook is sentiment on what the impact of these debt loads will be on spending priorities, and governments having to sort of do more picking and choosing of where they want to spend and where they cannot spend as much anymore. Economists seem to believe that when it comes to defense, all bets are off and spending will ramp up. However, when it comes to environmental protection, most likely spending declines. I'm wondering, would you generally agree with that outlook?
I think in general, if you want to call it, ESG, or generally the emphasis on making that climate the climate transition, if you want, or the transition to climate friendly energies, that was spearheaded very much by Europe, but also the US under the previous administration. I think that has clearly come to an end, and if not everyone is in the boat, and very large global emitters are not, no longer want to, implement the same policies. It makes less and less sense for the other economies to do it, because it's a public good. And so even then, if you try to do it, raise your costs for energy, others don't do it and emit, you would have a double negative whammy. The climate won't feel any impact, and at the same time, your own economy becomes less and less competitive with the others. So I think this is true, that there has now been a shift, and certainly a shift towards wanting to or having to spend more on defense, on military. I mean, clearly in Europe, this is one of the biggest realizations maybe of the last 12 months in particular.
However, I mean, as you mentioned, in Europe particularly, there may be some people who are happy to see a decline in, let's say, green spending, because they might feel like the region has gotten a bit ahead of itself at the expense of economic growth more broadly. How much validity is there to that? And is that maybe a bit of a dangerous road to go down?
As I said, Europe was spearheading this, but to some extent, it can only work if, as I said, if everyone does it together. And I think at the same time, you look at energy costs in Europe, in particular in core industrial countries like Germany, which are just much higher than the rest of the world, and companies feel this. And I think it's only a natural and probably fair reaction of these countries now to say, look, I mean, we can't pull this through by ourselves. There's probably also, one has to be frank, in the spirit of wanting to address climate change, there was probably sometimes a bit naivete, I would call it, in the way how, and now it speaks specifically about Germany, of how the energy transition was promoted and was pushed forward, maybe not thinking through all the different angles and the viability of it and base energy, etc. I don't want to go too far and also don't claim to be an expert on it, but I think there's a realization now at some points that that this was maybe not fully thought through, and in particular, it cannot be pushed through when there's no global global agreement of how one wants to go ahead with this.
I would be remiss if I did not ask about this because it's so much in the news right now. And, absolutely don't need to get into specifics of any particular country or any political aspect, but the issue of central bank independence, in a very general sense, is it true that most countries make at least some effort to separate the people managing the money supply, the central bankers, and politics? And if so, why generally do they try to do that?
You touch on a very fundamental issue. And I think the history has shown that when central banks became independent, and also some people attach it to became a clear mandate of a certain inflation target, or at least on price stability, coupled with independent, at least from the policy decisions, that has contributed to reduced inflation. And I think historically you can show this quite well if you look, from inflation from the 60s, 70s, 80s, and then how it came down in the 90s. It stabilized expectations. It's very hard to negate this. One can talk about here and there certain models and different types of independence, and but overall, I think central bank independence has shown to have contribute a lot to low and stable inflation. And it may be sometimes be underestimated how much the global economy or consumers, everyone really benefited from low and stable inflation. Once you had it for a few decades, and people who always lived with it, they may forget the benefits of it. And obviously, there has been a shock during, related to COVID and the monetary policy that was how it was conducted at the time. And, there's a lot of criticism about that, no doubt. And the inflationary shock that we saw in those years, that's something that, that populations still have to digest. But, whether the response to this is now to throw central bank independence, out, I would very much doubt that would be a good response. I would say that at the moment, when I look at markets, how they have reacted so far, they seem to be still quite unconcerned, if you want. After announcements in the U.S. in recent days, I look at markets here, and whether it's 10-year break-even inflation, 5-year inflation forwards, all the risk premium you would expect to jump hasn't really moved much. So it seems that the markets at least still seem to be quite convinced that message that I just said, the fundamental belief that central banks should remain independent is still strong enough.
Is there anything else from the outlook or otherwise that we should cover?
I would maybe just make a few points on inflation, since we were talking about it. And the interesting part is now there is actually, if you look at it globally, the development is quite diverse. There was a time when inflation was going up everywhere, and it was going down everywhere. Now we have a situation whereby, as I said, the US is still grappling with high prices and still an inflation that is above the 2% target. Europe is at the 2%, but a very large economy, second largest economy in the world, China, is actually in the opposite situation, where we have deflationary tendencies. And there, economists often would propose that they should loosen, for example, monetary policy further to help domestic consumption, and help domestic consumption in a way to drive a little bit more demand to bring prices up, because the disinflation in Japan of almost deflation is really a sign of very weak demand. So I think it's important to point out that the inflationary picture globally is quite diverse by now. And I think I would also make the point of energy, We talked about it in the connection of climate policy, but maybe another point that was one of the surprises in 25 was the continuous decline of energy prices, despite a lot of geopolitical tensions. And the OPEC, Saudi Arabia in particular, clearly here helped by boosting production despite relatively muted demand. That helped to bring in oil prices down. We now have additional geopolitical developments, but that has helped a lot with inflation, one has to say. Energy inflation, energy goes everywhere. It goes into food, into a lot of prices. And the fact that has come down, and the question whether it will stay where it is now or go down even further, I think will be an important aspect for 2026 as well.
Is it fair to attribute any of that inflation in the U.S. to tariffs directly?
What we see so far is the following. Some of the core goods, that core good inflation it has been going up, and we expect it to go up further in the coming months. So there's clearly pass-through from tariffs into core goods. There's no doubt. However, the headline number of that consumer basket, that is to a large extent actually no longer core goods. We live in a service society, and a lot of the service prices have been behaving quite favorably. In particular, for example, rents in the U.S. And so that's why if you look at overall inflation so far, has behaved maybe has been more moderately increasing than economists would have thought just from the tariffs. The question is, in a way, will this hold going forward into 2026?
Christian Keller, Head of Economics Research at Barclays Investment Bank. Thanks for joining us on Radio Davos.
Thanks, John. Great pleasure.
You can read the Chief Economists Outlook on our website, links in the show notes. Please follow Radio Davos, that way you can stay current with our daily morning shows direct from Davos during the week of the annual meeting. Subscribe wherever you are listening to this or at wef.ch/podcasts. Follow all the action from Davos at wef.ch/wef26 or across social media using the hashtag WEF26. This episode of Radio Davos was presented by me, John Letzing, and produced by our head of podcasts, Robin Pomeroy. Thank you for listening, and goodbye.